Alright, so hi guys. Everywhere I look, it seems that people are getting more and more pessimistic and getting more freaked out and panicking over what's happening in the stock markets. And some people are even asking, hey, could we really go into a bear market this year? And of course, what's freaking people out are two main issues. Number one is the potential Russian invasion of Ukraine that could create a war. And of course, the second thing would be inflation is getting higher and higher, getting out of control. Will it ever come down? And that could cause the Federal Reserve to raise interest rates up to 8 to 9 times this year, more than expected, and that could stall the economy into a recession. Now, I'm going on vacation for the next 2 weeks to a very remote location. I'll tell you where it is later when I get back. So I thought I'll do this video to put things in perspective, to share the facts, and to share about what you can expect in the markets and how should you respond to it. So with that, let's get started. So let's take a look at the charts. Now, from the beginning of the year, in January, we had this very sharp correction all the way down. Now, first of all, how do you define a correction? Let's get our terminologies straight. So correction is whenever the market drops more than 10%, right? Anywhere between 10% to 20% from its peak. That's a correction, right? So that drop over there was a total of a 12.3% drop from the peak. So that's a correction. And what happened was, once it hit that 12.3% mark, you could see a strong reversal back above this support, and it then traded back above the 200-day moving average. So if you recall, I released a video a couple of weeks back and I said, hey, the correction is over, the bull is back. Why? Because that was a very bullish signal, a sign that that particular correction was over. But since then, the bull has kind of like lost momentum. So what happened was the market went up, but it hit this strong level of resistance over here. And notice it coincides with this orange line, which is the 100 moving average. Now, previously, you can see the 100 moving average acted as a strong support level multiple times. It was supported, and now support has become resistance, right? So it hit that resistance, it came down, went up again, hit that resistance, came down again, and now the S&P is trading back below the 200-day moving average. So can we say that this bull is dead? Well, not yet. I would say the bull has lost momentum definitely, but it's not dead yet until if the price goes back below this previous correction low, then yeah, the bull's dead, right? And we have to wait for another bullish signal again. But till then, bull's not dead yet, right? Bull's like struggling, right? Losing momentum, right? So the question is, where do we go from here? Would the market bounce back up, or would the market go back down into another correction and retest these lows, or even go a lot lower? If you ask me where the market will go right now, it's really 50-50, because it really depends on what happens in Ukraine, depends on inflation. So a lot of things we can't predict where we are right now. So I'll get a 50-50, right? But the question is, if it goes down, where can we expect this market to bottom? Based on historical statistics, if this is a correction, we can expect the market to bottom anywhere between 13.7% decline from the peak, which is about 4159, to 17.1% correction from the peak, which is 3993. So in other words, if it remains a correction, the possible bottom of this market, the S&P, is between 3993 to 4158. So why those numbers? I'll take you through the statistics, historical statistics in a while, and explain why those numbers. Basically, if you look at all the corrections since 1974, the average drawdown has been 13.7%. But if you look at all the US election midterm years, which this year is a midterm US election year, the average drawdown of those midterm election years has been 17.1%. And that's how we get these two numbers. However, if this correction goes or becomes a bear market, then of course it could go a lot lower. So what are the chances of it becoming a bear market? I think it's extremely low. I think if you ask me, it's like less than 10% probability, and I'm going to explain why in a while, right? Remember, a bear market tends to happen only when there's a high probability of a recession. And we'll see in a while whether there is any chance of a recession on the horizon, right? Now, the difference is a correction is when the market drops between 10 to 20%. A bear market is defined when the market drops more than 20%. So you can see I put in this kind of like red dotted line. So this is the 20% mark. If the market closes below that 20%, that's a bear market, right? So let's take a look at the statistics. What's the chance of a bear market, and is it likely to happen? Now, since 1974 to 2021, we've had a total of 24 corrections in the last 47 years. So on average, we've got a correction once every 2 years. So if you think about it, the last correction was in 2020. So 2021, there was no correction. And now 2022, we have a correction. So we are right on cue. So this correction is actually something that should be very expected based on statistics. Now, the average correction, as I mentioned earlier, has a drawdown of 13.7%. So sometimes it drops 15%, sometimes 12%. But if you look at the average of all the corrections in the last 47 years, the average drop from peak to bottom is 13.7%. So far in this correction, we are down 12.3% from the peak. So like I said, don't be too surprised that we could go down a bit more. But again, it's a 50-50 chance. Even if it does, again, average 13.7%. But I did mention that, hey, this year is a US midterm election year. And based on the last 70 years of statistics, you can see that during midterm election years, the market tends to average an intra-year drop of 17.1% in those years. And that's why I say that this drop could be anywhere from a 13.7% drop to a 17.1% drop because of the midterm election year cycle pattern, right? But again, don't freak out if it happens because it's a great opportunity to buy stocks of good companies. Why? Because statistics have shown that after this drop, the market then tends to rally very strongly in the last 3 months of a midterm election year and the first 2 quarters of the following year, which is 2023, and the market tends to gain on average 32.3% after this 17% pullback. So after a 17% drop, market then gains 32.3%. So there's a great opportunity to again buy shares of great companies. Take advantage of that. Now, let's go back to that earlier slide. But like I said, if it moves into a bear market, then, well, you could get an even bigger drop in the market. So what's the chance of it turning to a bear market? Again, what's a bear market? A bear market is defined as the market dropping more than 20%. How often does a bear market happen? Well, in the last 47 years, there have been 5 bear markets. 1, 2, 3, 4, 5 in the last 47 years. So if you take an average, you get a bear market once every 9 years. So bear markets don't happen that often. All right. And so out of 24 corrections, 5 of them turn into a bear market. So in other words, statistically, 1 in 5 corrections turns into a bear market. And of course, in a bear market, the average drop is 32.5%, which is a lot bigger, right? But again, the question is there a chance that this could be a bear market? Could this be that 1 in 5 chance? I don't think it's likely because again, bear markets happen when there's a recession coming. So are there any signs of a recession? And what causes a recession? Recessions tend to happen when the Federal Reserve raises interest rates too fast and too abruptly. Now you got to understand something. The economy is like a car. Now when the car is going fast, going too fast, it gets heated up, and that's inflation. So the Fed has to slow the car down or you get a crash, right? So what they do to slow the car down is to step on the brakes. So stepping on the brakes is raising interest rates. So think about it. Every time the Fed raises interest rates, they're stepping on the brake to slow the economy down, to prevent it from getting overheated and high inflation. Now, what happens if the Fed steps on the brakes too strongly? Now, what happens if you step on the brake too hard? The car stalls, right? The car stalls, and that's when the economy goes into recession. So the question would be, of course, would the Fed make the mistake of stalling the economy by raising rates too fast? Now, they may do that if inflation never comes down. If inflation goes crazy, they may have no choice but to slam the brakes. So, will inflation go out of control? Or do you think it's going to come down? Well, no one can predict the future, but here's some good news. If you take a look at the 5.5-year cycle in consumer price index, now this is courtesy of Larry Williams research, you can see that the consumer price index that measures inflation actually goes through a 5.5-year cycle. It's a cycle, it goes up, goes down, goes up, goes down, right? And if you take a look at this cycle, look at where we are now. The black line is the CPI right now, and right here. And you can see that based on the CPI, it's approaching the 5.5-year cycle mark. Every 5.5 years, the cycle will turn, right? So in other words, we are getting pretty close to that cyclical turn in inflation, where inflation will peak really soon. Don't know exactly when, in the next couple of weeks, right? Maybe a few months, and then inflation will come back down again. So it looks like based on this cycle, we are near a turning point in inflation. Now, having said that, the Fed will still raise interest rates. So, question, will raising interest rates cause a recession? Will raising interest rates cause the stock market to crash? Well, not according to history. And I've shown this chart many times, and I want to show it again, that people think that interest rates going up cause the stock market to go down. That's not true. The anticipation of interest rates going up causes the market to come down temporarily. But when the Fed actually raises rates, when they actually do it, the market tends to go up. So in other words, in the long run, the stock market and interest rates, they tend to trend in the same direction. Look at the data. So for example, you can see back in the 1993, the Fed raised short-term interest rates from 3% to 6%. And what happened then? The stock market went up. And in 98, the Fed raised interest rates from 4.5% to 6.5%. What happened? The stock market went up. In 2003, the Fed raised interest rates from about 1% to 5%. What happened to the markets? Markets went up. In 2016, the Fed raised interest rates from 0 to close to 1%. The stock market went up. So Fed increasing interest rates is not bearish for the stock market. When it actually happens, it's actually bullish. All right. Now, then the next question would be, okay, that's short-term interest rates. How about long-term interest rates? How about the 10-year bond yield? Right? If the 10-year yield goes up, right now it's gone up to 2% and now it's come back down to 1.9%. If the 10-year yield goes up, will that cause a recession? Will that cause a market drop? Well, again, not according to data, right? Look at the data and you can see again, this orange line or golden line is the 10-year treasury yield, and this magenta line is the S&P 500. So what happened when the 10-year yield went up? Right, you can see that the 10-year yield went up from 1.7% to 3%, stock market went up. The 10-year yield went up from 1.3% to about 2.5%, market went up. The 10-year yield went from 2% to 3%, and the market went up, right? And the 10-year yield went from 0.5% to 1.7%, market went up. 10-year yield goes up, market goes up. So rising 10-year treasury yields do not cause a bear market or a recession, right? So right now we have actually gone up to 2%. And now we are back down to 1.9%, somewhere about there, all right? So what really is an indication of a recession coming? Now again, there are no 100% indicators, but the best leading indicator of a recession so far, the best and most accurate indicator is the yield curve. All right, the yield curve. So what's the yield curve? The yield curve measures short-term interest rates and long-term interest rates. If long-term interest rates are higher than short-term interest rates, the yield curve is upward sloping, and that means no recession, right? But if the long-term interest rate, like the 10-year rate, goes below the 2-year rate, we say it's an inverted yield curve. So when the yield curve inverts, that has predicted all the past 7 recessions, 100%. So it's the best leading indicator of a recession. So in other words, if you look at this chart over here, if you take the 10-year yield minus the 2-year yield, it should be positive. That means it's an upward sloping yield curve. But if the 10-year minus the 2-year turns negative, that's an inverted yield curve. That's a predictor of a recession. So right now, where are we? Right now, you can see that we are at 0.48. Now, people are freaking out because they say, hey, it's going down, it's going to hit 0 and go below, right? So again, if it hits this red line and goes below, that means, oh, the yield curve has inverted. Recession's coming, right? So we are not there yet, you know. You can see it happen here, it happened here, it happened here. And the last 7 times it happened, recession, right? By the way, even if this happens, even if this drops below 0 and we have an inverted yield curve that predicts a recession, does it mean that the market will crash into a bear market straight away? No. Again, if you take a look at the last 70 years of data, you will see that after the yield curve inverts, the stock market actually peaks and goes into a bear market on average 6 months later. So even if this inverts, you have got 6 months of bull before the bear comes. So that's a lot of lead time, right? So, but again, based on the current data, we don't see any recession on the horizon or any bear markets. And what about the war in Ukraine with Russia? Could it lead to a market crash, a bear market? I think not. Okay, that was my poor attempt at the Russian accent. I apologize. Right? But again, if you take a look at past geopolitical events like wars and so on and so forth, the market didn't drop that much. In fact, the market tended to rebound very quickly. And those were great opportunities to again buy shares of great companies at temporary discounts. If you take a look again at all these wars or all these geopolitical crises, the average drawdown of the market was just 5% because of these things, right? And the market tended to bottom within 22 days, less than a month, and within 47 days, it was back to all-time highs. So I wouldn't worry too much about this Russian-Ukraine crisis too much, except for the innocent civilians that could be harmed in that process. But as far as the market is concerned, it won't lead to a market crash or a bear market. The bottom line is that if you're invested in the index ETF or you're invested in fundamentally good companies that are profitable, you have zero worries because the index and good companies will always go up over time. But in the short term, there are always concerns, there are always worries, there are always problems. The important thing is to stay invested. Remember, the stock market is like a roller coaster. The only people who get hurt are those that jump off the ride halfway. And of course, those that get on roller coasters that are not well maintained, they fly off the ride, right? So these are the lousy stocks of lousy companies that are unprofitable. But again, if you invest in great companies, a solid roller coaster, it will always reach the end to the highest peak. But you just got to enjoy the ups and downs of the process. And in the words of Peter Lynch, remember this, that your ultimate success or failure in the markets will depend on your ability to ignore the worries of the world long enough to allow your investments to succeed. There are so many reasons to sell, but macroeconomic and geopolitical factors should never be a reason to sell. That's how you stay in the markets and you get huge returns over time. So I'll see you guys in 2 weeks or more when I get back from my vacation. Take care and may the markets be with you. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.